when it comes to qualifying for a loan, obviously we have the pre-approval, and there's a whole process, as you said, with underwriting. We get to the mortgage commitment.
Yep.
Now, briefly, what are some things that can happen in the process where the buyer is pre-approved, but something happens where the mortgage commitment does not happen? Because I have had that happen. Sadly, it wasn't my buyer, but it was a listing I had, and we were all excited, and went through the inspection and everything, and then lo and behold, right before the appraisal was ordered, no, I'm sorry, the appraisal was ordered, and we were ready, and then all of a sudden the the buyer's agent emailed me, and unfortunately the lender had to decline the whole loan. And so it was kind of sad, but
Yeah.
what type of things happen?
A lot can happen. A person can open, buy a new car.
Don't do that.
I have somebody just now that I pre-approved. They're under contract. Everything's moving along. We already did the commitment letter. The underwriter issued the commitment letter.
Okay.
And then the buyer's wife, who's not on the mortgage, added him to as an authorized user to her Amex.
Oh, okay. That's a good thing or a bad
No,
thing?
it's bad because because when you add an authorized user, you take on that person's debt.
Right.
So she added him as an authorized user to her Amex card, and then he has like a minimum. I don't know. Let's say it's $400. Now we have to add a minimum monthly payment of $400 to his debt, and that's causing his debt to income ratio to go too high. So now, he's not going to qualify unless he gets off that card again.
Okay.
So
the remedy to that is he needs to get off that card ASAP?
Yep.
Okay. So
That's
it's not too late.
Well, yeah, it's not too late. But what I'm saying, but like certain other situations where have come up where, a person like bought all their furniture. They opened a card at, Raymore and Flanagan and spent, $10,000 on furniture.
And it's already done.
And it's it. That's done. You're done.
Wow.
Dead in the water.
So that is a great segue to debt to income. So this is another thing that I don't think I think most people who are not in the industry don't know what DTI is or really understand that. So just typically, what is debt to income, and how does it change, or does it change between loan types, between FHA and conventional? Are there differences?
Yeah, there are differences. So debt to income is your income versus your debt. So we look at your gross income, not your net. So we gross income divided by 12. Right?
Okay.
Gross annual income divided by 12, and then that would be your income, your monthly income.
Mm-hmm.
And then
Sure.
we look at your monthly debt. Credit cards, your minimum monthly payment.
Okay.
Is part of so minimum monthly payment, not the payments that you make every month on the credit card.
Just what the credit card requires as a minimum. Okay.
Your auto leases and loans. If you have I don't know if you know this, but if you have less than 10 months payment on your auto loan, not lease, auto loan, we can disregard that debt.
Okay. So if you have less than 10 months left to pay, we can disregard the whole debt. Okay, gotcha. Okay.
But
That's good to know. Didn't know that.
Yep. So so your auto leases and loans, your student loans. So
Okay.
like let's say you're in deferment right now.
Mm-hmm.
Depending on the loan type, we have to use a 0.5% to 1% of the balance as a monthly payment.
Okay.
So like if you
1% of the
have
balance.
$10,000 in student loans, then we have to use $50 to $100, depending on the loan type, $50 to $100
in monthly debt. Monthly debt. Okay.
Yep.
Interesting.
And then that's how we figure out. So we figure out your debt that way.
Versus
all your
net
monthly obligations, minimum monthly obligations.
Okay.
As far as credit, credit cards, student loans, auto,
and any other thing that may.
We don't take into consideration your what you're going to be paying for. What do you call it? Electric and all that.
Okay,
Yeah,
right. The little small bills. Okay, not like your cell phone bill.
No, we don't need to take that into consideration.
Okay.
Just credit.
Just credit. Okay.
But so and then depending on the loan type,
Okay.
there's certain ratios, right? Like for FHA, let's
Sure.
say.
Mm-hmm.
FHA, you can have 55% debt versus income.
Versus income.
Right. So
okay.
I mean, I can't think of the calculations in my head,
Sure.
but you know, if you have $10,000 in annual, $10,000 in monthly gross income,
Right.
then what is it, 5,500?
$5,500 you can have in debt. Okay.
In debt, and the debt also includes your monthly mortgage payment.
Got it. Okay.
Your monthly, like your taxes, your insurance, PMI.
Includes what you would be paying.
Yep, what you would be paying in mortgage.
Okay.
Plus
so
your debt.
Plus your debt. Okay. So they're gonna look at the pre-approval amount. Now hopefully I'm not going off, but with the pre-approval, are you guys looking at taxes? Are you estimating a tax? How does that work?
Pre-approvals are pretty funny, right? Because it's so kind of backwards. We pre-approve you on the purchase price, right?
Right.
But really, what a pre-approval is a monthly payment.
It's a monthly payment, right?
Right. So you could be qualified. You can be pre-approved for a $500,000 house with $12,000 in taxes. But if you find a house with $15,000 in taxes and the same purchase price, you don't qualify anymore.
That is such a great point, and I think a lot of buyers don't understand that at all. You know, they look at the purchase price, like you said, and it's just like, oh, I can look at anything that's $500,000.
Right. So, like, whenever I have a borrower, we always talk, and the first thing I say is, what's a comfortable monthly payment for you?
Right.
Because that's another thing. A lot of lenders, they'll say you're qualified for $500,000, but those buyers have no idea what $5,000 a month, $500,000 costs monthly.
Monthly, right.
And I've had people be like, wait, no, I can't pay that per month. And then we like whittle it down and are like, all right, well, if you want to pay $3,000 a month in monthly mortgage, this is the price point you should be looking at. These are the taxes you should be looking at. And then, you know, I always follow it up with like, hey, before you go out and see this whatever property with your realtor, text me the address and I'll run the numbers for you.
Right.
You know, don't waste your realtor's time and don't waste your time going to see a place that it doesn't work.
It doesn't work. That's such a great point, because that is typically the issue with most buyers when they go out. At least in my experience, is they will look at that purchase price and try to look at every house that's that purchase price and below. And it's so important to understand your monthly payment. And even speaking to that too, is that, you know, when you get your pre-approval, as you said, they're looking at gross income, not net. So your gross income is what you bring in, but it's not deducting, you know, taxes. It's not deducting the actual expenses. So you may gross $100,000 a year, but really your net
taking 60,
right? You know, easily you take it like 60. So you really need to understand that. But it's so great, Dina, that, you know, you talk to buyers about that, because a lot of lenders do not.
Yeah.
You know?
Yeah, I've had a lot of situations where they're like, well, my other lender said I can do this. I'm like, yeah, you can do that, but it's going to cost you this per month. And they're like, I don't want to do that. I'm like, you can't.
It's I can tell you can do something, but then you also have to accept what it's going to actually cost to do it.
Right, exactly.
You know?
Yeah.
So that's such a great point. Wow.
But yeah, so like going back to debt to income ratios, it does change. It does vary per type of loan. Like, you know, like jumbo loans, for example, they have a tighter debt to income ratio.
So jumbo loan. What is a jumbo loan?
A jumbo loan is, I don't remember the wait, hold on.
That's all good.
You're gonna cut, right?
I'll edit it.
A jumbo loan, it's 720s. I'm trying to think of the loan amount. Well, a jumbo loan is
that like multiple properties in one?
No. It's just like a higher loan amount.
Oh, okay. So it's okay.
Yeah, all right. So a jumbo loan is, you know, somebody who's purchasing a higher price property, right?
Okay.
So for Essex County in New Jersey, the county we're in, you can get a jumbo loan from, I think the loan amount is $726,200, I think.
Plus.
Yeah, anything from that amount up.
Oh, it's considered a jumbo.
For a loan amount.
Interesting. Okay. Right. And then the debt to income is tighter.
It's tighter. Yeah, jumbo loans are tighter, right? Like you have to have reserves.
Okay.
You know, usually anywhere from 6 to 24 months of reserves. So reserves are the total monthly mortgage payment that you're going to be having. That times, like, let's say 6 months. So if your monthly payments, if your mortgage monthly payment's $10,000, you should have $60K in savings.
So if you're trying to buy that $1 million home, Don't try to do it on your last dime. It's not gonna happen.
Yeah, no, I know.
But if you're buying, I guess if you're buying a property that expensive, you typically
You would think.
you would yeah, you would think.
Not always the case though.
I'll bet.
But yeah. So like they have tighter requirements. One of them is DTI. It's you can only borrow up to 43% usually in a lot.
Got it. Okay. Now,
Or not borrow. You can only have a debt to income of 43%.
43.
So.
And like you said, typically the FHA is 55.
55. Conventional is 50.
Okay. Conventional is 50. FHA is 45. Jumbo loans about 43.
Yeah.
Interesting.
And
now,
then VA will go up high depending. VA there is no real set DTI.
Okay.
It just whether I don't know. We just get an approval or not.
Okay.
Yeah. VA depend. They have like a lot of. There's a lot of criteria with VA loans.
Now, so VA loans would probably be